Lastly, before we conclude the chapter, let's briefly review the impact of information asymmetry. So one of the assumptions that we had in the perfect world was that information is symmetric, meaning that corporate insiders and outsiders have the same amount of information and have the same access to the information. It means that both outsiders and insiders of the company know exactly same amount about the company. But we know that in reality, such assumption is hard to be held true. Okay, and we are going to investigate the signaling power that each payout method is carrying under the presence of information asymmetry. Before we discuss the signaling power of each payout policy, let's discuss this well-known phenomenon, which is called dividend smoothing. So the dividend smoothing refers to the phenomenon that firms rarely and very infrequently adjust their dividend, especially their regular dividends. So firms adjust dividends relatively infrequently, and dividends are much less volatile than earnings. Think about the sources of the dividend payment. Recall the standard income statement. The bottom line of the income statement is net income, and from this net income, the dividends can be paid out. So the source of cash to pay out dividend is the firm's net income or net earnings. Then, theoretically thinking, the firm's dividends have to be as much fluctuating as its source, which is the firm's net earnings. But the reality is far from that prediction. So let's take a look at the GM company's past 20-year dividend history and its earnings history. So in this chart, we are seeing GM's earnings and dividends per share history from 1985 through 2008. The red graph represents the firm's earnings over that period, and the blue bars represent the firm's regular dividend amount over the same period. What patterns do we read from this graph? So over that 20 plus year period, as we can see, the firm's earnings have been very much fluctuating and volatile. The red graph is all over the places. As opposed to that, how do you think that the blue bars are looking like? It's very stable, right? So although the source of the dividend payments are fluctuating all over the places, the regular dividends themselves, they have been very stable over that past 20 plus years. Actually, over that 20 plus year period, GM has adjusted on its regular dividends only 8 times. And it was only 3 times that it has cut its regular dividend amount, actually. So from this chart, which represents a typical pattern of the dividend payment, we can infer 2 facts. First, the firms rarely adjust their regular dividend. In other words, as we have discussed from the very beginning, dividends are sticky, especially the regular dividends are very sticky. And also, firms increase their dividends much more frequently than they cut them. So when the firm chooses to change their dividend amount, it's more likely to increase the dividend amount rather than to cut them. Okay? And firms actually raise dividends only when they perceive a long-term sustainable increase in the expected level of future earnings, and they cut them only as a last resort, only when they are really in a bad shape. So the clear fact is that firms do smooth their dividends, but there's no clear reason why they should. So one explanation is dividend signaling story. The dividend signaling story is the idea that dividend changes reflect managers' views about a firm's future earnings prospects. So now assume that we are living in a world with information asymmetry. Okay, so outsiders know less about the company than the insiders do. Okay, then the outside investors know that or assume that they know less about the company than the firm's insiders. Then what would they do? They will try to infer the firm's true status, or they will try to read the manager's mind by observing the observable, revealed policy decisions. And payout policy is one of those revealed decision making. Okay. So under the information asymmetry, this is how investors react upon dividend changes news. So when a firm increases its dividends, investors take that as a positive signal, meaning that management expects to be able to afford the higher dividend for the foreseeable future. Investors think that's why managers have decided to increase the dividend. Although there's no reason to believe so, investors somehow believe the changes in the regular dividend as an implicit commitment. Okay, so when there's a dividend increase, investors expect that the higher level of dividend will continue. The opposite is true as well. So when managers cut the dividend, investors take that as a very negative bad news, meaning that managers have given up hope that earnings will rebound in the near term, and to the point that the managers had to reduce the dividend to save cash. Okay, so therefore dividend cut news is greeted by a big stock price plunging down. Okay, and now knowing how investors will react upon the dividend increases or cutting news, to avoid unnecessary fluctuations in the stock price, managers try to smooth out its regular dividend amount, just to avoid unnecessary, unknowing stock price fluctuations. Okay, so that's what the dividend signaling is saying, and that's how dividend signaling story is explaining the phenomenon of dividend smoothing. Okay. When will share repurchases also carry the similar signaling power? Yes, it does so, but the power is much weaker. The most important difference between the share repurchases and this cash dividend is the level of commitment. As we have learned in the first lecture about the chapter, dividend payment, it requires more commitment. So when the dividends are once declared, it has to be paid according to the set schedule, right? But when it comes to stock repurchases, managers usually just announce the intention to use up to a certain amount of cash to undertake the stock repurchases. But the managers are not obligated to use up the entire cash amount, and share repurchases are undertaken over a very long period of time, very much subtly. So the level of commitment is much weak when it comes to share repurchases. So share repurchases give more flexibility to the managers, but the downside of it is the signaling power that it carries is much weaker than the dividend is carrying. So with that acknowledgement, still stock repurchases can be used to send some signal to the market. It has to do with the cost of share repurchases. And the cost of share repurchases depends on the market price of the stock. And when do you think the managers will decide to undertake the stock repurchases? Only when they think their current stock price is overpriced, right? Otherwise, actually underpriced. When the stock price is overpriced, then stock repurchase becomes costly, meaning that with the same amount of cash, the firms can buy back a much fewer number of shares when the price is overpriced, right? So only when the managers believe their current stock price is underpriced, they will rationally undertake the stock repurchases. Therefore, share repurchases can send a very credible signal that the shares are currently underpriced, or at least managers believe so. Therefore, in the reality, in the real world that we're living in, where the information asymmetry exists, oftentimes share repurchase news is greeted by stock price increases, which is unlike the outcome in the perfect world. In the perfect world, share repurchases does not affect the stock price, right? But in the world with information asymmetry, stock repurchase news can actually lead to price increase. Okay, so concluding, navigating the payout decisions, the financial managers of a company have to ask at least 3 questions to themselves. First of all, what are the tax implications for their shareholder base? Because tax is the most important and most powerful factor that determine the investor's welfare and therefore the firm's value and therefore the firm's payout policy. Second of all, financial managers have to ask themselves whether how much they value the flexibility that repurchases allow. Third question they have to ask themselves and also do the trade-off is how much they need the stronger signaling power that dividends carry. Okay, so the flexibility and strong signaling power, they are trade-offs. Okay, so repurchases give the manager more flexibility, but the signaling power is weaker. If the firm chooses dividend, the firm has to make more commitment, so loses flexibility, but it can carry much stronger signaling power. So here comes a general prescription for the financial managers when it comes to payout policy. So first of all, most importantly, for a given payout amount, managers have to maximize the after-tax payout to the shareholders. So you have to care about the leftover money in the shareholders' pocket after they pay out the taxes, because that's what investors care the most. Second, repurchases and special dividends can be useful for making large but infrequent distributions to shareholders. You have to be careful with the regular dividend, because when it comes to regular dividends, investors will expect much higher level of commitment. Okay. Well, so you should be more careful when you start or increase or cut your regular dividend, because starting and increasing a regular dividend is seen by shareholders as an implicit commitment to maintain this level of regular payout indefinitely. And therefore, the benefit of that is it can send a strong signal of financial strength of the company to shareholders. Okay, so when you use the regular dividend as your tool, you should be mindful of the level of commitment required and also the strong signaling power that it can convey to the market. Okay, well, at the bottom line, before we decide the payout policy to begin with, managers have to be mindful of the future investment plans. So only when the firm has no valuable investment plans, the firm will have to pay out the cash to shareholders. If the firm has valuable positive NPV projects within the company, then retention will be more valuable than paying out. Okay, so before the firm, the manager chooses between the dividend versus repurchase, to begin with, the investors have to be mindful of its future investment plans first. Okay, so this concludes the chapter, and that is all about the payout policies.